Hi, Professor Barati. I'd like to go over a comprehensive variance analysis example with you, including journal entries. And we want to do a direct materials, direct labor, variable overhead, and fixed overhead variance analysis, and do the journal entries. So a typical variance analysis problem has been chosen. So I will read it out to you. And as I read it out to you, I will try to explain some of the theory behind what we're doing. And I'm going to introduce to you this spreadsheet, which I've put together, and we'll forward it to you along with the problem, the video. So, Wagner Inc. manufactures truck tires. The following information is available for the last operating period. Wagner produced and sold 50,000 tires for $68 each. Budgeted production was 54,000 tires. Here are our standard costs per tire. Direct materials. It takes 3 pounds of direct materials to make one tire at $1.50 per pound. Direct labor. It takes 0.88 hours at $17.50. 0.88 hours to produce one tire at $17.50 per hour. The variable production overhead is in machine hours. It takes 0.28 machine hours to produce one tire at $15 per hour. So I've made some notes here. SP means standard price or standard cost. The standard cost or standard price of our direct materials is $1.50 per pound, $17.50 per hour, and $15 per machine hour. So our standard costs are already right there for us. Monthly budget for fixed production is $1,080,000. Fixed overhead is applied at the rate of $20 per tire. Now, in many problems, you might have to calculate the applied amount. They'll give you a monthly budget and tell you fixed overhead is applied at direct labor hours or machine hours. In that case, you take your monthly budget number divided by the monthly budgeted direct labor hours or machine hours to get a predetermined rate. And that would give you a rate per unit of production, in this case, a tire. You apply that rate to either the machine hours or the direct labor hours. Actuals. We are told direct materials purchased and used. Now this is a key point to say. Purchased and used, meaning we purchased everything and used everything. Later on, after this example, we will go to a more likely example in the real world where you don't purchase and use all your materials. We have beginning and ending inventory balances in materials, and therefore, in reality, you don't purchase and use all your materials, and we will address that later on in variance analysis. But for now, let's assume everything we purchased and used were all in the same month. So we used 175,000 pounds at $1.20 a pound. That's our actual price. Direct labor hours used were 42,500 hours at an actual price of $17.80. Variable overhead was 14,400 machine hours at $15.50 per hour. So everything we need to do our variance analysis is already given to us in this problem. There's very little figuring out needed to do. So what we're going to do is essentially apply these numbers to our spreadsheet, which is nothing more than a fancy formula. So now let's focus on direct materials. Let's work on the actuals first, the input. We know what our actual price per material is. Direct materials, actual price is $1.20. We know the amount of quantity used in the month of materials. We used 175,000 pounds. So the total dollar amount materials used for the month were 210,000. Next, let's go to our flexible budget. To prepare our flexible budget, we need to know what the standard price or standard cost price per pound. And it's given to us right in the problem. $1.50. Next, we need to calculate the standard quantity that should be used. Now, we are told that it takes 3 pounds to produce 1 tire. We sold 50,000 tires, but we budgeted 54,000 tires. A flexible budget basically says, as I stated in my earlier lecture, based on the current production, what inputs, what would our budget look like based on our current production, not based on the static master budget. Again, this is not the static budget. Do not put 54,000 here. It's 3 pounds to produce 1 unit. We produce 50,000 units. So it's 150,000 pounds. That's how many pounds we should have used to produce 50,000 tires. Essentially now, the middle column is really just part of the formula. You have your actuals and you have your flexible. The difference, the total cost difference between actual cost and flexible is your total variance of materials, total cost variance. As you can see, we used Our costs for materials were lower than our flexible budget by $15,000. Therefore, we have a favorable variance of total cost variance of $15,000. Now, what's driving that total cost variance? It actually per unit, on a per unit cost basis for materials, it cost us less. However, we used more pounds to produce 50,000 tires than we should have. Therefore, we were less efficient. But because it cost us less per pound, we have a favorable price variance. Notice I put the formula here. The formula is standard price minus actual price, standard price minus actual price times actual quantity. To get the price variance is the difference between the actual column and this column, the standard price times actual quantity. These are already known. You know your standard price already, and you know your actual quantity. So your price variance is the difference between your actual 210,000 and this middle column 262,000. It cost us less to produce 50,000 tires. On a price level, notice that the actual quantities are the same. Therefore, we've what's called isolated the quantity. The quantity is not a factor here because it's the same for both columns. The factor here is the price. It costs us 30 cents per pound less to produce each tire. Therefore, the formula, standard price minus actual price times 175,000 tires, gives us a favorable variance of $52,500. You can do it by simply using your spreadsheet, or you could plug the variables in your price variance formula. You'll get the same result. Now, to calculate the efficiency variance of materials, how efficiently do we use our direct materials? Notice that our standard price is the same between the two columns. So we've isolated the standard price as to not be variable or be a driver in our calculation. So to be efficiency variance is really an activity variance. Notice that we use more pounds to produce 50,000 units than we should have. We used 25,000 more pounds, which resulted in an unfavorable efficiency variance of 37,500. And here's your formula. It says standard quantity, 150,000, minus actual quantity, 175,000, times standard price of $1.50. You'll get the same result. I like to use the spreadsheet because I think visually it's going to help me make the journal entries than just plugging in the formulas. And it also helps me visually see what's driving the variance. So the difference between 262 and 225 is 37,500 unfavorable. It costs us more overall to produce the 50,000 tires in quantity. but it costs us less to produce 50,000 tires in price. So those are your two components. Overall, price plus efficiency equals total variance, which is 210 minus 225. Next, let's go to our journal entries. This is where your knowledge of job costing and process costing comes in. Basically, workflow or cost flow through your inventory models. From here, we can do a journal entry. Now, the flexible is based on the standard cost. The standard cost is a basically determined standard rate that we basically will put into our inventory system. And every time we put production in place, whether it's tires or computers or whatever, we have standard costs for all our parts, or pounds or grams. Those standard costs basically repeat themselves. It's always going to take $1.50 times some part or some pound or something, and debit WIP at standard. So WIP gets a debit for $225,000. Notice I put in parentheses STT, meaning standard. Always use standard costs to debit WIP, which is what's reflected in the flexible. We're supposed to have used 150,000 units at $1.50 a unit or pound. So we're going to debit WIP for that. However, as you know, WIP is not correct at 225. It actually costs us 210. You do have to record your cost of goods sold at actual cost. So if standard and actual off, and they're very rarely equal, you're going to have variances. So your accounts payable credit will always be the actual column. Simple enough. So now we have 225 and 210, so we have this gap here. The difference are going to be our variances. So let's see. We're going to have a material price variance, which is a journal entry, and a material efficiency variance. These accounts will later get reversed and put into cost of goods. Basically, they're just temporary holding accounts until we're done at the end of the month. We close them out and we put them in cost of goods sold. Honestly, in practice, for example, in the company I work for, we just put them to cost of goods sold. We don't have variance and efficiency accounts. We have a cost of goods sold variance account separate from cost of goods sold so that we could track our variances. But we cut out the step of all these journal entries. It can go right to cost of goods sold. Now, you might want to have one account just called cost of goods sold variance like we have, so that at least you could see how much variance you have between your standard and actual. It's important that you do capture that so that the accounting and the operations departments can improve the standards and thus improve the costing of your product. But let's just stick with the text. And so we have a material price variance, material efficiency variance journal account. Again, a temporary account to hold the variance until we're ready to move it into cost of goods sold. So the 52,500, as you can see, is your variance, your price variance. Now, why is it a credit? Essentially, our price was lower than our standard But keep in mind, the standard, which is higher, is what's flowing through our inventory. It's flowing through our materials, it's flowing through our WIP, it's flowing to our finished goods. When it's completed, it goes to finished goods, and when it's sold, it goes to cost of goods sold. But the reality, we're only paying $1.20 per pound. So at some point, we've overstated our cost of goods sold by 30 cents a pound for every pound we produce and sold. So we have to make a journal entry to essentially get cost of goods sold accurate at the end of the month. So the price variance is favorable, meaning that our cost of goods sold should be lower than what we're recording at this moment. Therefore, if it's going to be lower, you want to credit material price variance, because to clear it out, you need to debit it and then credit cost of goods sold. So you start out with the credit. Conversely, the efficiency variance, what's happening here is throughout this production of 50,000 tires, we have recorded 150,000 pounds instead of 175,000 pounds. So our standard is telling us that we're a little, we're basically recording our cost of goods sold too low. We use more materials, but we're fooling our accounting system at the moment by saying we only used 150,000, but we really used 175,000. So temporarily, our cost of goods sold is going to be understated. So we want to capture the variance here and debit that, because what's going to happen when we close this out, we're going to credit this account and debit cost of goods sold. So don't let the debit and credit fool you. Efficiency doesn't mean favorable because it's a debit. It's almost counterintuitive. It's a credit meaning unfavorable, and that's why I have it in red to mean unfavorable. So now let's look at trying to figure out our direct labor. We know our standard price per labor hour is $17.50. We know our actual labor hour rate is $17.80. So we already know our standard and actual price. So let's put them in our spreadsheet. Direct labor, $17.50 per hour for our flexible, which is our standard. And I'll put standard here so as to better define the column. So standard is $17.50. The actual price per hour is $17.80. So our middle column here, which is basically a version of the flexible budget for direct labor, we already know what our standard price per hour is. Now let's work on our quantity. Actual quantity is 42,500 hours. standard quantity. So let's review that. Here's where we'll have to do a little calculation. Under standards, it takes 0.88 hours to produce one tire. We produced 50,000 tires. Therefore, 0.8 hours to produce one tire at 50,000 tires is 44,000 hours. We should have used 44,000 hours to produce 50,000 tires. But we only used 42,500 hours to produce 50,000 tires, which means we were more efficient in the quantity, the number of hours used. On the price side, the opposite has happened. Our standards say we should have cost us $17.50 per labor hour, but it turned out that we spent $17.80 per labor hour. So we were not as good on the price side. So our total direct labor cost variance of $756,500 was lower than our standard by $13,500. That's favorable. But as you can see, the components of the total variance, price and efficiency, are going in different directions. It cost us more per labor hour this month to produce 50,000 tires, which was unfavorable, but we used less hours to do it. 42,500 versus 44,000. Therefore, the price variance unfavorable plus a favorable efficiency variance gives us a total cost variance of $13,500. And here's your formula. If you want to use the formula instead of the spreadsheet or the chart, you would take standard price, $17.50, minus $17.80 actual, times actual quantity, equals an unfavorable price variance of $12,750. The efficiency variance formula is standard quantity minus actual quantity times standard price, which gives us a favorable variance of $26,250. So this confirms that you did the spreadsheet correctly. So let's create a journal entry. The journal entry for direct labor is always use your flexible standard to record your debit to WIP, because that's what's going through the system. The system is taking 44,000 hours and multiplying it by $17.50, because that's what we put in our accounting system as a standard. So that's what's flowing into WIP as a debit. However, our wages were actually $756,500. And what I will call this is, instead of AP, let's call it accrued wages payable. That's the reality. That's the actual wages paid. That's what we're actually going to pay our employees, so that should be our wages payable. However, we have a difference here. So Again, we have a direct labor price variance account and a direct labor efficiency variance account. Much like the material and price and material efficiency accounts, these are temporary accounts. They're just holding accounts that will be cleared out, and those variances will end up in cost of goods sold. Essentially, they're cost of goods sold accounts being held temporarily. The $770,000 is what initially will get posted to cost of goods sold. But that's a standard, and the standard isn't the actual. So eventually our cost of goods sold is going to be overstated by $13,500. So let's look at our direct labor price variance. We have an unfavorable variance, which means that we spent more in labor hours. So that unfavorable variance has to, basically what it's saying is that our price variance was on a cost of goods sold level too low. We need to add more cost to our cost of goods sold because this is unfavorable. Notice our $17.80 actual versus our $17.50. The $17.50 is what's flowing through our inventory accounts into cost of goods sold. So it's understated. So we're going to have to add to our cost of goods sold. So to do that, we're going to credit our price variance because it's unfavorable. Eventually, this gets closed out as a debit. It should be the other way around. My apologies. This will be credited and then debited to cost of goods sold because it's unfavorable. The efficiency variance gets the credit. Because we were more efficient, we used less hours than standard, our cost of goods sold is overstated. So we're going to have to reduce it by the $26,250 of efficiency. And that would basically be, to clear this out, we'll need a debit and credit to cost of goods sold. Next is the variable overhead. Our variable overhead in our problem, overhead is 0.28 machine hours to produce one tire at $15 per hour. We use 14,400 machine hours at $15.50 per hour. So let's work on our variable overhead. 15.50 is our actual rate. Actual machine hours used, 14,400. Now let's work on our flexible or our standard cost side. This is where we have to do a calculation. It takes essentially 0.28 machine hours at $15 per hour. So let's figure out our standard costs. If it takes 0.28 machine hours to produce one tire, we produce 50,000 tires. So if it takes 0.28 hours to produce one tire, and we use 50,000 tires, we produce 50,000 tires. Our quantity is 0.28 times 50,000 tires. Our standard price is given to us in the problem at $15 per machine hour. So our total variable cost overhead variance is $13,200 unfavorable. But let's see what's making up that $13,200 unfavorable variance. Let's look at our price. It cost us $15.50 per machine hour actual, but our standard was $15. So we were 50 cents higher per machine hour this month than our standard. So we are going to have an unfavorable price variance. And based on our formula right here, that price variance is $7,200 unfavorable. Now let's look at our quantity. Our standard quantity of machine hours, we should have used 14,000, but we actually used 14,400. That means we were less efficient. We used more machine hours than our standards said we should have used. Therefore, the difference between 216 and 210 is a 6,000 unfavorable efficiency variance. So our total cost variance, variable overhead variance of 13,200 unfavorable is due to an unfavorable price variance of 7,200 and an unfavorable efficiency or quantity variance of 6,000. Again, using the formula, you just plug in your variables and you get the same amount. Now let's go to our journal entry for variable overhead, which is a little bit different than materials and direct labor because we have applied and over-applied and under-applied entry to make. So initially, and this is from another problem, so I'm going to get rid of that. Initially, our debit to WIP is always our flexible standard for variable overhead. So we're essentially debiting WIP by 210,000 and we're crediting factory overhead applied. Remember our T accounts. But the actual variable overhead came in at 223,200 actual. Remember, the actual doesn't get debited to WIP. Remember our job costing and our process costing? Actual gets put into a control account. The next step what materials and labor do not have is we're going to close these accounts. Because remember, they have to go to cost of goods sold eventually. So we're going to debit factory overhead applied. And we're going to credit the factory overhead control to eliminate those accounts at the end of the month. So if you remember in our cost flow chapters, the difference between factory overhead applied and factory overhead control goes to cost of goods sold, which you could perfectly do GAAP doesn't require this. So a lot of systems will just debit or credit cost of goods sold. But for our sake, for the theory's sake, again, now we have our price variance and our efficiency variance control accounts, which essentially will be closed out and go to cost of goods sold anyway. So indirectly, these will go to cost of goods sold. So let's look at our variances. We have an unfavorable variance of 7,200, price variance. So we're going to debit that because to close it out, we have to credit that and then debit cost of goods sold. The efficiency variance under factory variable overhead is 6,000. And therefore we balance. Now eventually these are closed out. These will get transferred to cost of goods sold. It's a bit confusing, but in the end we're doing the same thing. If you had just put this right to cost of goods sold, it probably would be perfectly acceptable. Now let's go to our fixed overhead. This looks like it's from another problem, so I'm going to get rid of these amounts. Fixed manufacturing overhead. Again, notice the change in the column headings. Different than the variable cost side, materials, labor, and variable overhead. Because fixed manufacturing overhead really doesn't have efficiency variables. They're not, even though they're unitized in our absorption costing system, fixed manufacturing overhead obviously gets into a product cost, so it's unitized. And therefore, we do have to account for the variances. However, they're fixed, so there's no cost behavior here that we have to worry about. So we just simply put our actuals in. Our monthly budget is $1,080,000. Actual fixed overhead is $1,145,000. Now we have to figure out our fixed manufacturing overhead applied. What's going to be applied? So let's go to our problem here and try to figure that out. Fixed overhead is applied at the rate of $20 per tire, so it's given to us. So our total fixed manufacturing overhead variance is $145,000, unfavorable, which consists of a price variance and a production volume variance, both unfavorable. So let's do our journal entry. By now, you'll now know that the debit to WIP is going to be what's applied. The factory overhead control account is what's actual. Like the variable overhead, we have to close the applied and the control to cost of goods sold. But in theory, we have to use our variance overhead and product volume variance accounts as temporary holding accounts, which eventually get closed out. So let's close out our applied. And let's book our variances. Now I won't link this because if you use this for other problems, you might have to have a credit. So I won't link this. So essentially, our price variance is unfavorable by 65,000. So we're going to have to debit cost of goods sold, which means we start out here as a debit. The production volume variance basically means that we are under, our cost of goods sold is too low. So we're going to have to add 80,000 to that, which means we're going to have to start out as a debit here. And these are your journal entries. However, we're not done now. We have to close out our variances in each section to our cost of goods sold. So here we go. In the problem, it says total WIP is completed. So we're going to take what's in WIP and move it to finished goods because it's completed. So what's in WIP? Equals, let's go to our journal entries. Direct materials. $2,205,000. Now, if you didn't want to go through what I did, basically add them all up, you could just go to your flexible standard and just take them right off of there. Because as we stated, WIP always gets the flexible standard. Now we sold these tires, and in our problem, it tells us they were $68 each. Which is $3,400,000. Don't forget the sales. Now, what's our cost of goods sold? Our cost of goods sold is essentially going to be coming out of finished goods and into cost of goods sold. So it's going to be the same. Now let's take care of our variances. We're going to close them out. Material variance. Had a credit of $52,500, so we're going to debit that to close it out. The efficiency variance had a debit of $37,500, so we're going to credit that. Let's go to our labor variances. Direct labor variance had a debit of $12,750, so we're going to credit that out to close it out. Direct labor efficiency variance had a credit of $26,250, so we're going to debit that. The overhead, variable factory overhead, had a debit of $7,200, so we're going to credit that out. And $6,000 on the efficiency side, right here. So that gets a credit to close out. Remember, these are temporary accounts. They're just holding accounts until we get to the final entry where we will put them in cost of goods sold here. Now on the fixed side, $65,000, $80,000 had debit, so we have to credit them. So the difference to balance our journal entry is $129,700. And the way to prove that is you can go into your spreadsheet right here and just add up your total variances. 15,000 plus 13,500 minus 13,200 minus 145,000 equals 129,700. Unfavorable. Total would be unfavorable of 129,700. That 129,700, because it's unfavorable, means you need to increase cost of goods sold. So let me put a formula here just so you can tie it out. That 129.7 being unfavorable is a debit to cost of goods sold, so you know you've done this journal entry right. And that concludes the entire comprehensive direct materials, direct labor, variable overhead, and fixed overhead variance analysis and journal entry problem. We will move on to the situation which is where the direct materials are not all purchased and used in the same month, which is very convenient for us. In reality, we will move on and demonstrate how to record direct materials when we purchase and use different amounts, because in reality, our T account will always usually have an ending balance. So I hope this helps you understand variance analysis a bit better. Thanks.